All right, let's get into this. I'm going to break this down for you, just me and you talking, because what is happening right now is honestly one of the wildest things I have ever seen in my career. So, look, we need to talk about December 2025. You probably saw the charts, right? Silver did something that it hasn't done in, about 45 years. It just completely smashed through that $60 per ounce ceiling and it didn't look back. It just kept climbing. Now, if you turn on the TV, the financial news guys, they're all patting themselves on the back. They are telling you, oh, it's just a supply crunch. Or hey, everyone is just excited about the Federal Reserve cutting rates. It sounds logical, sure. But I have to tell you, they are not telling you what is actually happening. They are leaving out the most important part of the story. While everyone was staring at the green candles on the chart, JP Morgan, the same bank that paid $920 million in fines for rigging the silver market, was busy pulling off what might be the most brilliant financial heist in the history of commodities. I mean it. And if you are a regular person, a retail investor holding those paper silver certificates or ETFs, you are about to learn a very, very expensive lesson. It's a lesson about the massive difference between thinking you own silver and actually holding the metal in your hand. Here is the stuff the headlines are convenient forgetting to mention. You have to look at the timeline. Between June and October of 2025, JP Morgan didn't just quietly close out a short position. No. They closed a short position that was massive. We are talking 200 million ounces of paper silver contracts. Think about that. For over a decade, they used those contracts to keep the price down, to suppress it. And then, poof, gone. For the first time in modern history, JP Morgan has exactly 0 short contracts in silver. But, here is where it gets really disturbing. They didn't just go to neutral. They didn't just step away from the table. They flipped the board completely. They went long, and not just a little bit long. They accumulated over 750 million ounces of physical silver. I want to be clear, here I'm not talking about paper contracts. I'm not talking about shares in an ETF. I'm talking about actual heavy metal sitting in a vault. Metal that cannot be printed by a central bank. Metal that cannot be margined or frozen by some regulator. To put that number in perspective for you, 750 million ounces. That represents almost an entire year of global silver mine production. It is staggering. It is more silver than the famous Hunt brothers ever tried to corner back in 1980. It is more than the entire registered inventory of the Comex multiplied by 15. Think about that scale. JP Morgan now controls more physical silver than the strategic reserves of most countries combined. Now, the math on how they did this? It is just mind-blowing. If they closed out 200 million ounces of shorts while silver was averaging, say, $30 an ounce during that June to October window, they generated about $6 billion in cash. That's a nice payday. But the real question you should be asking is, where in the world did they get the other $44 to $50 billion to buy 750 million ounces of physical metal? Here is the mechanism that nobody is discussing. JP Morgan didn't walk onto the open market and buy this silver. They couldn't. If they tried to buy that much volume publicly, the price would have gone vertical immediately, would have spiked to the moon. Instead, they used their position. See? They are the largest vault operator for the Comex. They are the custodian for SLV, which is the biggest silver ETF out there. So they used that access to quietly transfer metal from allocated storage into their own proprietary accounts. You need to think about what that means for a second. For years, retail investors, people like you and me, bought shares of SLV thinking, hey, I own silver. But if you read the fine print, it says SLV holds physical silver in custody. And guess who that custodian is? It's JP Morgan. Now, through these complex lease arrangements and vault transfers that, don't really show up in the public filings the way you'd expect, JP Morgan has essentially moved that metal from your column to their column. The timing. This huge accumulation happened while silver was still trading in the low 30s. And why was it that low? Because it was being suppressed by the very short position that JP Morgan was unwinding. It's brilliant, in a scary way. They were simultaneously the seller covering their shorts and the buyer accumulating the physical metal. They were effectively paying themselves to corner the market. And, if you need proof, here is the smoking gun. It proves it was coordinated. On October 15th, 2025, the United States Mint made an announcement. They said they were suspending sales of Silver Eagle coins because of supply constraints. Now, that is just government speak for we can't get any metal. The Mint buys silver from the same Comex vaults that JP Morgan controls. Let that sink in for a moment. The United States government could not source enough silver to mint its own coins. Meanwhile, at that exact same time, JP Morgan was adding 21 million ounces to their hoard in just 6 weeks. But the real tell, the thing that gives it all away, is in the Comex data itself. As of December 2025, if you look at registered silver, that is the metal that is actually available to be delivered against futures contracts, sits at approximately 50 million ounces. That's it. Meanwhile, the open interest, the paper bets on silver exceeds, I'm 50 million ounces. That is a 19-to-1 ratio of paper claims to physical metal. In any other market, in any other business, we would call that a Ponzi scheme. You literally have 19 people holding receipts for every single 1 ounce of actual silver that exists in the vault. And JP Morgan just quietly removed 750 million ounces from the pool that was backing those receipts. This is where the comparison to the Hunt brothers becomes critical to understand. Back in 1980, Nelson Bunker Hunt and his brother, they tried to corner the silver market. They used a lot of leverage and paper contracts. They managed to drive silver from $6 all the way up to $50 an ounce in just months. But then the government stepped in. They changed the margin requirements overnight. The Hunts were forced to liquidate, and they ultimately declared bankruptcy. But JP Morgan. They studied that playbook. They learned from those mistakes. They learned the fatal flaw the Hunt brothers made. The Hunts used paper to control a physical commodity. Paper can be regulated. Margin requirements on paper can be changed. Credit lines can be frozen. The government has infinite tools to crush paper speculation. Physical metal. That is different. JP Morgan isn't borrowing money to buy this silver. They aren't using leverage. They're parking a portion of their massive $37 trillion balance sheet into the most manipulated commodity in history. And they are doing it right before they stop manipulating it. And here's the final piece that confirms this is a coordinated endgame. Look at the lease rates. JP Morgan lease rates for silver spiked 40% in October 2025. They remained elevated at around 8% as of early December. Now, lease rates are what institutions charge to lend out silver. When those rates spike, it means physical metal is disappearing from the lending pool. Translation: JP Morgan isn't lending their 750 million ounces to short sellers anymore. They are cutting off the supply. That supply was the only thing keeping prices suppressed. The shorts at the other banks, HSBC, UBS, Scotiabank, they are now exposed. They are out there without their biggest supplier. This isn't just a short squeeze, folks. This is a supply coup. And everyone still holding those paper promises is about to learn what counterparty risk really means. Let me show you the receipts. Because what JP Morgan just did, it isn't speculation, it's documented, it's historical. And it is following a blueprint that they literally paid $920 million in fines to perfect. On September 29, 2020, JP Morgan admitted to systematic precious metals manipulation. The Department of Justice settlement revealed that between 2008 and 2016, JP Morgan traders used spoofing algorithms. They placed massive fake orders to manipulate prices, and then they canceled them before execution. They did this over 50,000 times. Let me read you the actual statement from the DOJ so you know I'm not making this up. JP Morgan traders placed orders to buy and sell precious metals futures contracts with the intent to cancel those orders before execution, creating a false impression of supply and demand to manipulate prices. The scale of this was staggering. John Edmonds, a JP Morgan precious metals trader, admitted to spoofing gold and silver markets on almost a daily basis for years. Greg Smith, the head of precious metals trading, directly oversaw this scheme. These weren't just some rogue traders in a basement. This was institutional policy. But here is what is chilling. That $920 million fine covered manipulation through 2016. JP Morgan's silver short position continued until October 2025. That's 9 years after the official manipulation supposedly ended. They paid the fine, kept the strategy, and rode it for another decade. Now look at what they were suppressing. The Silver Institute's 2025 Supply and Demand Report shows that industrial consumption hit 121 billion ounces. Solar panels alone consumed 264 million ounces. That is up 18% year over year. Electric vehicles added another 110 million ounces. Electronics, 5G infrastructure, defense applications, they all pushed demand to record levels. But mine production was only 830 million ounces in 2025. That creates a 380 million ounce structural deficit. That metal had to come from somewhere. It had to come from above-ground stockpiles. And those stockpiles are estimated at just 1.5 billion ounces total. And that includes JP Morgan's 750 million ounce hoard. So do the math with me. If JP Morgan holds 750 million ounces and the total stockpiles are 1.5 billion, they control half of all the available silver on Earth, and they are adding to it while industrial users are scrambling for supply. Here is the evidence of that scramble. Silver Lease rates the cost to borrow physical silver jumped from 2% in September 2025 to 8% by December. That is a 300% increase in 3 months. When lease rates spike like that, it signals one thing: there is no metal available to borrow. But, it gets worse. Comex registered silver again. That is the metal actually available for delivery has been draining catastrophically. In January 2025, registered silver stood at 78 million ounces. By June, it was down to 64 million. By December, it is down to approximately 50 million ounces. Meanwhile, open interest, the total number of silver contracts outstanding, exceeds 190,000 contracts. Each contract represents 5,000 ounces. That is 950 million ounces of paper, claims against 50 million ounces of physical metal. A 19-to-1 ratio. Now overlay JP Morgan's accumulation timeline on top of that. They closed 200 million ounces of shorts between June and October. That is exactly when Comex registered silver was plummeting from 64 million to 50 million ounces. They weren't just covering shorts, folks. They were removing supply while covering. The historical parallel is undeniable. In 1979 through 1980, the Hunt brothers accumulated approximately 100 to 200 million ounces of silver. They drove prices from $6 to $50. But they made a fatal mistake. They used futures contracts and leverage with only a fraction in actual physical possession. When silver hit $50, the Comex changed the rules overnight. On January 21, 1980, the exchange enacted Silver Rule 7. This restricted futures contracts to liquidation only. No new buying was allowed. The Hunt brothers, leveraged to the hilt, couldn't meet their margin calls. Silver crashed to $11. Within weeks, they declared bankruptcy. JP Morgan watched that case study closely. Their 2025 strategy is the anti-Hunt playbook. The Hunt brothers' fatal flaws were using leverage. Borrowing heavily against positions, holding mostly paper contracts instead of physical metal. accumulating publicly, which triggered a regulatory response, and having concentrated positions that were easy to target. JP Morgan's corrections: zero leverage. They are using balance sheet cash. 750 million ounces of physical metal, accumulated through vault transfers and custody arrangements that are invisible to the markets, and distributed across Comex vaults, London vaults, and ETF custody in a legally bulletproof structure. Here is why the government can't pull a 1980s-style intervention this time. The Hunt brothers were speculators. JP Morgan is a systemically important financial institution. They are the primary custodian for U.S. government silver reserves and the largest silver ETF. They aren't attacking the system, they are the system. Even more important, JP Morgan isn't using derivatives or leverage that regulators can margin call. They own the metal outright. The government cannot freeze physical silver sitting in private vaults. They can't change margin requirements on an asset that has no margin. They can't force JP Morgan to sell what they own free and clear. Now let's talk about timing. The Federal Reserve began its rate-cutting cycle with a 25 basis point cut in December 2025. Fed Chair Powell signaled continued easing in 2026 if economic data supports it. Translation: real interest rates are heading negative. History is unambiguous about what happens to precious metals during easing cycles. From 2001 to 2003, the Fed cut rates from 6.5% to 1%. Silver rallied from $4.50 to $8. That's a 78% gain. From 2007 to 2009, the Fed cut from 5.25% to zero. Silver rallied from $12 to $48. That's a 300% gain. From 2019 to 2020, the Fed cut from 2.5% to zero. Silver rallied from $14 to $30, a 114% gain. Notice the pattern. Each easing cycle creates a bigger silver rally. Why? Because industrial demand keeps growing while mine supply stagnates. JP Morgan accumulated 750 million ounces right before the December 2025 rate cut, precisely when the smart money positions for the easing trade. But here is the smoking gun that proves this is coordinated. On December 11, 2025, the Economic Times published a report stating JP Morgan's silver flip. The article cited sources familiar with vault transfers confirming the 750 million ounce accumulation. That is not a leak, my friends. That is a signal. Why would JP Morgan let this become public? Because they are done accumulating. When you leak your position after you finish building it, you are ready for price discovery to begin. You want the market to know you are long, so the shorts panic and cover, driving the rally. You are positioned for the squeeze. Final piece of evidence. JP Morgan Q3 2025 earnings showed a $62 billion increase in other assets on their balance sheet, with minimal explanation. At $32-$35 per ounce average during Q3, that is roughly 177 to 206 million ounces of silver. The numbers align perfectly with the reported accumulation timeline. This isn't a conspiracy theory. This is forensic accounting. And it all points to one conclusion. JP Morgan didn't just close their short position. They engineered the greatest commodity position reversal in modern history. And they are about to profit from the squeeze they created. Now, let me show you the math that JP Morgan's traders have already calculated. Because there is a specific price target, a specific timeline, and a specific event that triggers the squeeze. And once you see it, you will understand why they accumulated 750 million ounces right now. Start with the simplest metric: inflation adjustment. In January 1980, silver peaked at $49.45 per ounce based on the London fix, using the Bureau of Labor Statistics CPI inflation calculator. That same purchasing power in December 2025 equals approximately $187 per ounce. But that is using official CPI. If you use shadow stats methodology, which includes food, energy and housing costs that were removed from CPI in the 1990s. The real inflation-adjusted 1980 peak is closer to $600 per ounce. Let's be conservative and use the official number, $187. Silver closed December 2025 at approximately $60. That is a 212% upside to reach inflation-adjusted historical highs. On JP Morgan's 750 million ounce position, every $1 increase equals $750 million in profit. At $187 per ounce, if their purchase cost was an average of $35, we are talking about a gross profit of $114 billion. That is a 435% return. For context, that is more than JP Morgan's entire 2024 annual profit of $49.6 billion. But the real target isn't $187. It is the gold-to-silver ratio reversion. Throughout history, silver has maintained a relatively stable ratio to gold. For most of the 20th century, that ratio averaged 15:1 to 50:1. In nature, silver is approximately 15 to 17 times more abundant than gold in the Earth's crust. The market ratio should reflect that geological reality. As of December 17, 2025, gold trades at $4,200 per ounce and silver at $60 per ounce. Current ratio, 70:1. That is historically extreme. During the 2011 precious metals peak, the ratio briefly touched 32:1. During the 1980 Hunt Brothers squeeze, it reached 17:1. Even a conservative reversion to 50:1, with gold at $4,200, implies silver at $84 per ounce. A 40% gain from current levels. But here's where it gets interesting. If gold rallies to $5,000 per ounce during 2026's Bank of America, BNP Paribas, and Goldman Sachs have projected down the gold-to-silver ratio reverts to even 30:1. Silver hits $167 per ounce. At 15:1, the historical geological ratio. Silver reaches $333 per ounce with gold at $5,000. JP Morgan's profit at $333 per ounce. 750 million ounces times 333 equals roughly $250 billion. Minus their cost basis of roughly $26 billion equals $223 billion in profit. That is 45 times JP Morgan's entire 2024 annual profit from a single commodity position. Now, let's talk about the trigger event. The specific moment when this goes parabolic. And it's not speculation, it's math. Comex registered silver is currently around 50 million ounces. It has been declining at an average rate of 23 million ounces per month since June 2025. At that burn rate, registered silver hits 40 million ounces by late February 26. Why is 40 million ounces critical? Because that is approximately the threshold where Comex can no longer honor delivery requests without triggering a default cascade. Here is why. At any given time, approximately 5 to 8% of open interest demands physical delivery. With 950 million ounces of paper, claims 190,000 contracts times 5,000 ounces each. That is 47 to 76 million ounces that could demand delivery in a given month. Longs stand for delivery instead of rolling contracts. Well, you see the problem? When registered silver falls below 40 million ounces, the exchange faces a mathematical impossibility. They cannot physically deliver against even normal delivery demand, let alone a squeeze scenario where longs refuse to roll. What happens then? The Comex has three options. Option 1, cash settlement. They force contract holders to accept cash instead of physical delivery. But cash settlement at what price? Its physical silver is trading at $100 in London, while Comex offers $60 cash settlement. Contract holders will sue. This creates a two-tier market and destroys confidence in paper silver. Option 2, emergency rule change. Restrict contracts to liquidation only, like the 1980s Silver Rule 7. But that triggers immediate panic selling of paper while physical premiums explode. You would see $60 paper silver coexisting with $150 physical silver. Complete market breakdown. Option 3. Source emergency supply. Borrow silver from ETFs or sovereign stockpiles. But who is the largest ETF custodian? It's JP Morgan. And they aren't lending. Lease rates prove it. Game over. All three options lead to the same conclusion. Paper silver and physical silver decouple. The 900+ million ounces of paper claims become worthless IOUs. While physical metal like JP Morgan's 750 million ounces trades at true scarcity value. Now, let's map the timeline with specific milestones. Q1 2026, January through March, registered Comex silver falls below 40 million ounces. Projected for February 1st, delivery failures or forced cash settlements occur. The paper physical price spread widens to 20 or 30%. Silver breaks $100 per ounce in physical markets. JP Morgan's position value hits $75 billion. Q2 2026, April through June, Comex implements trading restrictions or circuit breakers. SLV and other ETFs face redemption suspensions. Industrial users panic buy at any price. Silver reaches the $150 to $180 per ounce range. JP Morgan's position value rises to $112 to $135 billion. Q3 through Q4 2026, July through December, the gold to silver ratio collapses toward 30-1. The Fed continues easing. Real yields turn deeply negative. Silver reaches the $200 to $280 per ounce range. JP Morgan's position value explodes to $150 to $210 billion. This isn't a prediction. It's inevitability. The math doesn't lie. You have 950 million ounces of paper claims, 50 million ounces of registered physical, and 750 million ounces locked in JP Morgan's vaults. Something has to break. But here is the final warning, and this is specifically for anyone holding paper silver. If you own SLV shares, Comex futures, or allocated accounts at major banks, you need to understand what allocated means. In a squeeze, allocated doesn't mean yours. It means assigned to you on the custodian's books. When physical silver hits $200 and paper trades at $80, your custodian will offer cash settlement at the paper price. You will have no choice. Read the prospectus. Force majeure clauses allow cash settlement during extraordinary market conditions. JP Morgan spent decades manipulating silver lower while accumulating the world's largest physical hoard. They paid $920 million in fines to perfect the playbook. They studied the Hunt brothers' mistakes. They positioned right before the Fed's easing cycle. This isn't a bet. This is a siege. And if you are still holding paper promises when registered silver hits 40 million ounces in February 2026, you aren't an investor. You are collateral damage in the greatest commodity coup in history. The choice is simple. Own physical metal that cannot be printed, margined, or settled in cash. Or own a receipt for silver that JP Morgan already controls. They have made their choice. The 750 million ounces prove it. Now make yours.